What's going on, guys? Today I wanted to talk about 5 stocks that I see as potential buys, plus 1 stock that I've already bought and I'm considering buying more of. So I appreciate you watching, and if you like the video, make sure you drop a like down below, and if you haven't already, make sure you hit the subscribe button. The first stock we have up here is Vital Farms, and they are a producer of pasteurized, ethically raised meats, eggs, and items kind of like that. And the reason they interest me is you can see their 52-week low is $15, while their 52-week high is actually $34. And right now they're sitting a lot closer to their 52-week low. In the last couple of days, they've ran up a bit, so they're up 7% in the last 5 days. A lot of that basically coming on the back of earnings. But if you look at their 6-month chart, they're down 10%. Their year-to-date chart, down 25%. Their year chart, they're down 40%. So I love looking at companies like this where they've established that they can reach prices like this, but basically they just undergo kind of some hard times and see a pullback in the stock price. So what's kind of boosting them right now is their most recent earnings. They've kind of seen some recent growth, and what you're seeing here is they reported earnings that were up year over year of around 50%. Or basically, sorry, they beat earnings by 50%, and what you see is they expected to lose 6 cents when they actually reported 3 cents, and then their revenue was also a beat. So they're kind of running on the back of that, but the reason this company is kind of lower on my list is they haven't really been able to consistently make profit when you look at the last 4 quarters. They have a couple quarters here where they actually reported profit, but these kind of other quarters, they're still reporting a loss. I generally like to look for companies that are able to make money and consistently basically make money. So the second stock here I have is Zynga, and Zynga is actually a social media game producer. So they make games like Farmville that you see here, and a lot of the with friends games. So chess with friends, boggle with friends, and then they have words with friends down here. So what interests me in Zynga is they've actually had a lot of growth, and again, you're seeing that they're really close to their 52-week low. So they've recently bounced basically off their 52-week low. In the last 5 days, they've gone from around 690, again, compared to their 52-week low of 675, all the way up to $7. But when you look at their 6-month, they're down 25%. Their year-to-date, they're down 20%, and then year, they're only down basically 3%. So this is a stock where, right, it had a boost based off COVID. You kind of saw the stock run up, see a lot of positive things going for it. It's kind of established that it can get up to around the $10 mark, and it kind of is starting to bounce back up and show a trend that it kind of wants to head back up there. So the earnings, again, not the best, but they are showing kind of at least some profitability. They're kind of starting to turn a corner where they're seeing that they can be profitable, and they're doing a lot better job of advertising on their games. All their games are free to play, which I think is the right way to go, but they basically push advertisers onto the games, and that's how they make their money, which I think, again, is kind of the way you saw things trend. If you ever played Fortnite, you saw Fortnite go that way. Call of Duty with Warzone also trending that way. So there's a lot of games where now they're free to play. They either push ads or have in-game purchases, and I think that's probably a good way to go. So I could see them kind of growing on that and keep expanding, whether it's on Facebook or other kind of forms of social media, and kind of just keep the growth going. So for number 3, we have Las Vegas Sands, and Las Vegas Sands is a casino resort company. So they obviously operate in Nevada, Las Vegas, Nevada, as well as kind of Southeast Asia, specifically China, Singapore, some of those countries down there in basically Southeast Asia. So this is primarily a COVID recovery play. So they've kind of been beaten down kind of over and over again and haven't really fully recovered. So you can see here on the 6-month chart, they're down almost 29, almost 30%. Year to date, they're down 31%. In the last year, again, around 30%. So really what I'm looking at here is the stock has consistently shown that it can get up and kind of maintain around the 60, 50 to 60 kind of price point. So what we're looking at here is, right, we're at all-time lows even over the last 5 years. Here, in the depth of the pandemic, kind of when everything was looking its most bleak, we were actually down at $37, so not much below its current price. So really what I'd be looking for is the fact that kind of it's been able to kind of bounce off and trend upward. So we're kind of seeing that again, right? It's kind of down here, and we could see it bounce up and kind of trend back upward. And that presents kind of, if it can get back to the $60 mark, you're looking at a 50% return off its current price. So the next stock up here, we have Chegg. So Chegg sells, basically they rent textbooks, and they also basically sell a service where they will provide tutoring and solutions to textbook answers. So it's good for students, one, who basically want to cheat, to be honest, and then also it does provide kind of educational help, right? So you can walk through step by step through solutions in the textbook. As far as the company goes, they've been beaten down a lot. They just announced earnings, and in their earnings call, basically the CEO talked about a reduction in people taking harder classes in college, and basically them seeing that the overall education sector is pulling back, thus affecting Chegg. So in the last week, they kind of had earnings, and they're down almost 12% just in the last 5 days. In the last month, they're down 50%. So they're actually down from $60. And if you kind of look over time, their 52-week high is $115, and that's kind of in the midst of the pandemic. You kind of saw, as everyone was having schooling from home and everything was online, right, a lot more people purchasing Chegg and having a subscription to Chegg. So basically that's kind of their biggest run up that they've had in the last year, but they're back down even below kind of and kind of at where you saw pre-pandemic. So I don't really foresee Chegg going away, and I think their business model, if anything, a lot of the students that use Chegg over the last year, they're not going to just get rid of their subscription, right? They might have got rid of it for the summer, but I think a lot of them, right, they kind of had that handicap, got it to experience kind of the benefits of Chegg, and I think they'll kind of get back into it, and they'll just kind of keep growing their business. So I see a lot of upside potential in this one. Again, kind of potentially bouncing back up to the $60 mark, but I do think Chegg has to execute and make sure that they maintain those relationships kind of with students. So the last stock before we get into the bonus stock is PayPal. So PayPal, as everyone kind of knows, they support online money transactions. If you didn't know though, they also have a few subsidiaries, the biggest being Venmo. A lot of people, at least I know, use Venmo. I personally use Venmo to send cash kind of to friends and stuff. Whether you're going out, right, and your friend pays for your meal, you might reimburse them on Venmo. So that's a big, very easy app to use. And then PayPal, I've most commonly used it for eBay transactions and things like that. But what's most exciting kind of about PayPal is it's the largest market cap of any of the stocks we've looked at so far, and it has still been beaten down quite a bit. So just in the last 5 days, again, they had a very poor earnings call, so they're down 11.5%. On 5 days, they're down almost 20% on the month. In 6 months, they're down around 17%, and then kind of year to date, only down 11.5%. So they had all-time or 52-week highs of around 310, which is kind of back here in July, and recently just have kind of plunged down further and further. Again, kind of as COVID turns around, you're seeing a lot of these people who support online transactions kind of fall off and kind of experience some rough patches due to the fact that, right, people are going out more, they're spending more in person and doing different things. So you've seen PayPal pull back, and right, it's presenting kind of a 50% upside. So 300 compared to its current price of 200, there's basically a potential upside of $100 there. So you're seeing 50%, a potential profit of 50% in this stock. So the bonus stock that I promised you is Alibaba, and Alibaba is the stock out of all of these that I'm most interested in. So the 52-week high, you're seeing 280, and the 52-week low was 138, and right now we're sitting at 163. So I've bought a large position already in this stock, and my cost basis is around 150 to 155. So recently, in the last few days, it kind of dropped back down into the 158, 159, and I was starting to get interested again in buying a little bit more, expanding on my position, but it's kind of bounced up a little bit. So if we see it pull back before earnings, which are on November 18th, then I'll probably buy a little bit more, expand my position. But for right now, I'm kind of happy with where I'm at. It kind of just needs to get back down to my cost basis for me to want to add more, basically. But again, you have a huge upside in this stock. So it's only sitting at a 19.5 PE ratio, and there's still plenty of room for it to run up. The reason it's been beaten down so much is, right, all the fears around China with the regulation and everything that's coming down from government. There's been a lot of big tech businesses over there that have been severely regulated. But I still think Alibaba, it's in a position where if it executes, it's basically going to be the Amazon of China, right? So I think long term it's going to pay off, and a lot of big investors like Charlie Munger, Ray Dalio, they're all bullish on China and on Alibaba in the long run. So I hope you enjoyed the video. If you did, like I said, make sure you drop a like down below. The biggest takeaway that I hope you had from this video is kind of how at least I look at stocks, right? So I love seeing stocks that have been recently beaten down and where they can possibly pull back up to. So if we have a stock and it's beaten down to $30, but it had a recent high of $60, right, it's proven that it can get back up to 60, or that it can basically maintain $60. It's just a matter of whether it's the business has fundamentally changed for the worse. If that's the case, then you want to avoid the stock. Otherwise, if it's just beaten down because of the perception of the business, which is what I personally believe is happening with Alibaba and basically all Chinese stocks right now, then I see it as a good investment, because, right, perceptions change over time, and it's kind of easy for a stock to flip and the perception around it to change, and basically that can cause a huge run up in price. So anyways, I hope you enjoyed the video. If you did, like I said, drop a like down below. If you want to see more videos like this, make sure you subscribe. And if there's any videos that you want to see in particular, just leave a comment down below and I'll check them out, and I'll kind of let you know what my thoughts are on any stocks, whether it's stocks themselves or options, kind of whatever you want to see. So I appreciate you guys watching, and you have a good rest of your day.